Bank Negara Malaysia announced to keep OPR at 2.75%. That was unexpected. Further away from home, China reopened its borders, first time in 3 years. So what do these mean to retail investors like us? Hi everyone, I'm Mr. Teh from The Modern Remiser. Welcome to the first ever episode of Market Highlights. In this series, we would update the interesting event that happened recently and see how we can adjust our portfolio according to these events. Now let's see what happened in January 2023. So Bank Negara Malaysia announced to retain OPR at 2.75%. Currency-wise, that would depreciate Malaysia ringgit and results in higher important good price and lead to inflation. But on the bright side, that would also put monthly loan repayment to ease, which is a good thing because Malaysia household debt to GDP is quite high at 85%. But to the banking sector, this is definitely a negative surprise. We have downgraded the banking sector from overweight, which is bullish, to market weight, which is neutral, back in the December 2022. To recap, the banking sector has outperformed FBM-KLCI by a lot since March of 2020, which was the lowest point during COVID-19. The banks are able to outperform FBM-KLCI mainly because of NIM expansion. So what is NIM? NIM stands for Net Interest Margin. It is the difference between the interest that the bank pays to the depositors and the interest that the bank charges the borrowers. So during an interest upcycle, when the rate of your FD is still fixed, when the rate in your current account, saving account has yet been revised upwards, almost immediately you have to pay for higher monthly loan installment because there's this floating feature in most of the loan, and that caused the NIM expansion. However, this NIM expansion is not going to last forever. Sometimes we have this misconception that the higher the interest rate is, the more the bank can earn. That is not true, mainly because the market is efficient. The interest that the bank pays to the depositors will eventually catch up, especially when the banks have to fight for the deposits. This is exactly what is happening right now. Also, the declining CASA ratio in Malaysia banking sector is going to impact the NIM as well. So what is CASA ratio? CA stands for current account and SA stands for saving account. CASA ratio measures how much of the total deposit is made out of CASA. Bank love CASA because when you put your money in current account or saving account, they don't have to pay you much interest compared to other sort of deposit like FD or bond. So as you can see here, the CASA ratio before COVID, pre-COVID, it was 26%, and then it went to peak at 33% during COVID-19, and now it is 31%. In other words, there's still room for it to go down. And we estimate that for every 1% drop in the CASA, the NIM would be dragged down by 2%. So with the limited upside of OPR, repricing of the deposit, and the downward normalization of the CASA, it is likely that the NIM would peak in fourth quarter 2022 financial report, and it will start to reverse in first quarter of this year. In other words, the best days of the bank is likely to end soon. You might want to ask me, what if we can't keep the inflation under control and there's another round of upcycle of interest rate? True, the interest rate is correlated to the NIM, thus the bank profit, but only to a level. Going beyond that level is going to break the market. Imagine that the interest rate goes so high that people stop taking new loan, or people start withdrawing their deposit, or worse, people going default on their monthly loan repayment. Then the increase in interest rate will not do the banks any good. Of course, we are not there yet, but I'm just trying to point out that the relationship between the banks and the interest rate is not linear in that sense. Another major event happened in January was the rapid and surprising reopening of the China economy, with the complete dismantling of zero-COVID strategy and reopening of borders. China reopened their first tier city on 6th of December 2022 and their lower tier cities on 8th of January this year. Hang Seng Index has since rebounded almost 50%, becoming the world's biggest mean reversion story. It has also triggered a rise in the Chinese yuan and lifted the entire boat of the Asian forex exchange. Reopening of the Chinese economy is a piece of good news to the market, but the rebound seems a little bit too fast. The Chinese economy is not out of the woods yet. Here are the few concerns. First, we need to monitor how will China deal with the initial wave of infection, especially after the Chinese New Year, as they will impact the activity and growth in China and then sentiment for the region. Second, China still has to resolve the funding crunch faced by the real estate sector and the local government. For the real estate sector, the issue runs deeper than near-term financing needs. In order for the developers to remain viable, the demand has to return. And how can this be achieved under the houses are for living, not speculation mantra? All along, households have seen real estate as a form of savings, with asset appreciation being the key feature. Third, if global growth does not improve and US Fed stay on the tightening path, it will have negative implications to the China's economy. The US dollar cycle will continue to dictate the pricing trends of emerging market assets, including the Chinese equities. I believe the worst is already over for the China's market, but we suggest paying attention to the potential profit taking in the near term, as the market focus may now shift from sentiment to improvement in fundamentals, and that remains to be seen. Okay, that's all for the highlight in January. One disclaimer is that most of the information presented here came from the opinions of research analysts published in January, which is last month. Some of this information is time sensitive, so by the time this video gets published, they may or may not be still relevant. If you want a more timely and frequent update on the market, you can click the link to the Google form below and my team will get in touch with you. If you like this video, do the usual, like, share, subscribe. Until next time.